All right. It's 101 for those of us in Pacific time, unusually. It's 4:01 and the market is closed for the week after a rather ebullient run for the bulls as we started the year. I'm Wook Capital Management's Managing Director, Rod Alsman. We are going to get underway with our weekly Wook in Review. We have a couple of hopefully good topics to talk through this afternoon. I'm just going to read a brief disclaimer to get us started and then can get into the content. Just as a note, today won't be sharing my screen I am traveling. We are mobile, don't have my current usual setup. So I won't be sharing my screen in Discord Live today. For those of you who don't receive the newsletter, you can click in the Wook Capital handle. Just in the profile here, you can sign up, you can receive it. You can also pull the newsletter up and just view it on your own. Joe is going to pin it here to the nest in a moment, the little thread that we converted it into. But anyways, disclaimer, do need to let everyone know that Wook Capital Management Inc. and its employees do solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. All right, with that mouthful out of the way, thank you for joining our first Wook in Review of February 2023, our 18th Wook in Review to date. We have a couple of topics to get through today. I think the call will probably run a little bit shorter. I'll probably be able to get through the prepared remarks in about 30 minutes or so. And then if anyone wants to join in the conversation, by all means, please request to be a speaker. Come on up, share your perspective pertaining to any of the three topics today. So I have three in the newsletter. I obviously didn't know what the payroll report would be this morning, but we can kind of weave that into the Powell discussion. So the three topics are: one, we have Ryan Cohen, RC Ventures manager, is reported in the Wall Street Journal and then followed on by Bloomberg that he's taken a stake in Nordstrom and continuation of his kind of pivot into activist investor mode. So we'll talk about that. We're going to talk about Powell and the Fed Open Market Committee meeting, the statement, Powell's Q&A, what it means, as well as kind of the payroll, as I noted, numbers this morning that were excellent. There's no other way to put it. If you are a fan of the U.S. economy growing, it is a good data point to see. And then thirdly, we have big tech. Of course, we had really all the big players have reported now. We had three of the big players report yesterday after the close and Meta the day before. So we'll talk about big tech earnings and what is that telling us about the outlook. So first off, we'll talk about Cohen and what's going on there. So we had, you can see the lovely meme that Joe put together when I saw that Cohen was going after Nordstrom. It reminded me that Mark Triton, the former CEO of Bed Bath & Beyond, is a member of the board at Nordstrom. He used to work there. The reporting indicated that it sounds like Cohen is seeking a targeted board refresh. Sounds like an attack on Triton, if you will, to use the meme parlance I have there. Cohen had pushed Alibaba. They're reporting in mid-January is that Cohen pushed Alibaba to increase and speed up their share buybacks. And this was reported in Reuters and Wall Street Journal, other media outlets in January. I've seen some folks who are skeptical of the news reporting because there's no filing. I would remind those skeptics that the requirement to file isn't breached until you hit that 5% beneficial ownership mark. So with a company like Alibaba, where you have a market cap of a little under $300 billion. Cohen's reported ownership stake is in the hundreds of millions, so that represents about 1/10 of 1%. So there wouldn't be a filing. Cohen has a PR. Cohen has his own PR. He's, as we've observed, used the Wall Street Journal as his preferred outlet du jour. And I think it's safe to say that if, if he were not actually taking these stakes and actions, he would be pushing back, and his team would be pushing back on the reporting. So I know there's some people who don't think it's real unless there's a filing. I would point them to that. So with regard to the, just again, Alibaba, you had Cohen, of course, come to fame on the tail of his activist stake that he took in GameStop in 2020. In August of 2020, he took a 9% stake, and that played out through to his successful coup with the GameStop board, where he seated 3 members of the board, and he himself became chairman of the board. You've got his Bed Bath Beyond campaign from earlier in 2022, in March 2022, where he took, again, a meaningful stake. He got a very rapid settlement with the board, of course, as things deteriorated for that business, and as Mark Triton, the former CEO, was shown the door in June of 2022, and we're now seemingly days away or weeks away or any day now from a Bed Bath Beyond filing. He did, of course, exit that position. So he has now run, this would be his 4th activist campaign if we think about GameStop, Bed Bath, Alibaba, and now Nordstrom. So the guy, clearly, he said, Warren what do you say, Warren Buffett by day, Carl Icahn by night, something like that. He clearly fashions himself after Carl Icahn. He clearly has a lot of respect for Carl Icahn. There was, of course, the picture he shared with Carl Icahn at his home in South Florida. So Carl Icahn is, of course, a famed activist investor, really, really feared, I guess, in some corners and well respected in most. So I think this is just a continuation of him doing what he's said he's interested in doing. If he sees bad governance, he's interested in seeking to improve it. In the case of Nordstrom, it seems like the reporting show that he has a lot of respect for Nordstrom. The family owns about 30% of the company. So it does seem like it's not a major activist move, but an opportunity to make a slight shakeup. It'll be interesting to see when and whether we get a filing that he owns over 5%. Otherwise, of course, if he doesn't, JWN is the ticker. The market cap today closed up again 25% after the news came out after hours yesterday. So clearly the stock benefited from his involvement in the short term. The market cap's 4.2 billion after today. So for him to have a 5% stake, we're talking over $200 million. So it's entirely possible his stake is in that sum. If so, we'd see a 13D filing. Otherwise, this just could be a continuation of his interest in shaking things up at various public companies where he thinks the governance is inadequate or lacking, and that there's an opportunity for return. So certainly here, though, there's the perception that it's a little bit of a vendetta against Mr. Triton. We'll see what happens there. Okay, so moving on then from Mr. Cohen, and certainly welcome any thoughts on that again after I get through the last 2 topics. We've got Mr. Powell. So Mr. Powell, the Fed Open Market Committee met on Tuesday and Wednesday. We had the Fed statement come out at 2 o'clock on Wednesday. I included, and you could see the visual from John Author's column that showed the intraday move in the 2-year Treasury yield on Wednesday. And, it didn't really move too much. In fact, yields went higher after the statement came out slightly. Equities were pretty flat after the statement came out at 2. So really, it wasn't until Powell began speaking during that Q&A, which I think in this environment, it is worthwhile to monitor the Fed. with how tightly hewn the markets are to everything they do and say. Obviously, the market liked what it heard from a risk on perspective. So with the Q&A, I didn't. There was a chart that had every single mention of disinflation during the call. If you think about it, that was the magic word that the market heard that led to the reaction. That yields went lower, meaning bond prices went higher, equity prices went higher. If yields go lower, that means people are bidding, right? They're buying bonds. Yields down means prices up. Equities rallied, especially long-dated equities, right? The NASDAQ rallied far more than the Dow Jones because the NASDAQ is more interest rate sensitive. So seeing those yields falling was a tailwind for valuations for long-dated equities like those that comprise the NASDAQ. It's really what there was a couple of things that happened during the call. One in particular was when it was really the first question asking about financial conditions, and Powell asserted that financial conditions had tightened over the last year, which if you look at the Bloomberg Financial Conditions Index, if you look at the Chicago Fed Adjusted National Financial Conditions Index, there's a lot of indices out there that seem to show otherwise. So the fact that he talked about disinflation repeatedly seemed to that financial conditions hadn't in fact loosened seemed to really be all that the bulls heard. But there were a few things he said that I think are important to remember. He noted that they still believe that they need to have multiple hikes from here out, which would imply they lowered the rate of change from the really aggressive 75 basis point moves that we've been seeing in 22. They lowered the rate down to 25 basis points. So 25 basis point hike from the Fed. The expectation from Powell and the messaging from Powell being that there will be more hikes to come still, as indicated in their December summary of economic projections and December SEPs. There were a few questions in the Q&A about whether those SEPs were still relevant, and there was some demurring by Powell insofar that he said, those are the current SEPs. Of course, they will update them come the March meeting based on the incoming economic data. And the incoming economic data, at least in the very short period since that meeting, has been pretty stunning in that we got over 500,000 payrolls added in December. The expectation was for, I think it was under 200. So a huge beat on the non-farm payrolls, as well as a revision upward for December by tens of thousands. We now have an unemployment rate that's dropped further. It's down to 3.4%. So from a labor market perspective, and Powell noted, right, we're seeing the disinflation in goods, and we've been seeing the disinflation in goods. The expectation, just based on how housing-related services works, is that disinflation will begin to appear as we get a year, just based on how there's lags in, even though we know for months now, of course, rents have been trending down. Newly signed rents on like a month-over-month basis have been trending down. It has to flow through to the data. So the last piece of the inflation puzzle is the services inflation, excluding housing, and that's where the sense was that there's definitely more confidence on the Fed side that a soft landing can be achieved now, seemingly, than there was in late 2022. The data has largely aligned with that to date. While the labor market remains just out of whack, it seems, right? You had the job openings report, the JOLTS report for December come out on May, and it showed that you had, again, an uptick in openings, which is not really what you want to see if you're the Federal Reserve. And then with this really strong payroll report, as well as continued strong growth in wages, albeit at a year-over-year reducing pace, it still seems like there is a misalignment here where when you look at the Fed funds futures curve, there's an expectation for multiple rate cuts by the year end, and yet that services ex-housing inflation has yet to really begin to disinflate. and you see a continued misalignment between labor supply and labor demand. So we'll see how it plays out. We'll keep monitoring it. Clearly, the market was extremely enthusiastic. There were a few different data points I saw this week. For example, I saw reporting that retail percentage of overall trading activity hit an all-time high in late January. I believe it was 23%. It was of mix, so even in excess of levels in 21 and 22. The Thursday was the highest options volume of all time, and call options volume also extremely elevated. So you have a lot of trading activity by retail. You have a lot of short covering. Goldman Sachs Prime Book, I saw that we're talking like 99.8th percentile moves in short covering over the preceding decade. So just a lot of really wonky stuff going on in the market. A lot of enthusiasm. Bear markets are vicious for bear market rallies, and clearly anyone that was positioned short heavily at the end of two has gotten their face ripped off. So, eventually, when there's no one left to buy, then and that becomes a problem for, I guess, the bulls. If the shorts covering begins to slow and the retail buying begins to slow, and if you see a change maybe in kind of the underlying economy, it remains to be seen where things go from here. So, a couple of quotes from economists. Just again, I recommend you be signed up to Wall Street Journal's real-time economics emails. I think that their team does a good job of compiling things. So a couple quotes from different folks. You got from Wells Fargo, quote, even after accounting for the flattering seasonal effect on January payrolls, today's report argues for the Federal Reserve to stay in a hawkish mood. The economy may be slowing, but the labor market didn't get the memo. Tongue-in-cheek one. We've got from S&P Global, while it's nice to see more people getting jobs with fatter paychecks, it's hard to ignore the fact that those wage gains have been negative when adjusted for inflation. Including January, they will have been negative for 22 straight months. So that is one kind of key here, that on a real basis, even though you've had these really strong nominal wage gains, they've still been negative in a real terms, given the elevated inflation and levels. So just some different commentary. Again, we'll welcome thoughts when I get through my last topic item here. So lastly, again, we had the big tech earnings. Now, I did include the visual, which obviously the manufacturing ISM doesn't really relate to these technology companies, but I think it is still a good visual to keep in mind. And I've talked about the ISM New Orders Index a few times over preceding Wook reviews and market open mics. You've got this continued deceleration in growth. In fact, you've got contraction on the manufacturing side of the economy from the ISM kind of diffusion index being below 50 for several months now. The new orders index has been below 50 for 9 months, I believe, now. So on the manufacturing side, that's happening. And then we're hearing from software. So we heard last week from Microsoft, which we hosted a Wook earnings call. You're welcome to check out the replay on our YouTube channel. Microsoft warned of slowing, decelerating growth in cloud. And as you should have, I guess we as investors should have expected, Amazon followed up that AWS is also seeing deceleration in cloud growth. You also saw Apple report its biggest revenue miss in over 5 years, with unknown challenges in their supply chain in China due to the iPhone City issues in terms of production. You also had them lapping a MacBook launch in the preceding year. They didn't have the same launch this year. So either way, a big miss on the revenue side. And it's important to remember that companies like Apple are still being valued as though they're growing quite rapidly, right? Apple trades at 25 or so forward earnings multiple, and that's typically reserved for high growth companies. Apple doesn't really fit that bill right now, at least as you look in the short term. I've made this point before. I haven't looked at the most recently revised net of yesterday, but that free cash flow for Apple is only projected to grow cumulatively in the single digits through mid-decade. So it's not really meaningful growth. It's growth, but it doesn't strike me as commensurate with the valuation being placed on it. On the side of Google, you had a drop in advertising revenue. Microsoft had noted that at least with Bing, they were picking up some share. So maybe people are deciding to go back to Bing away from Google. There's no jest there, but it was their first drop in advertising revenue since the beginning of the pandemic. So that what represented a company-wide a 3.6% drop. Still a big number, right? 59 billion in advertising revenue in the quarter. They're clearly still the biggest player in that space. We talked last week about the lawsuits coming, or the prospective lawsuit coming from the federal government, from the Department of Justice. There was news today that Amazon is also going to face an FTC suit potentially. So a lot of risks from a growth deceleration and also regulatory front for some of these major tech players. But prices were down after earnings, after hours yesterday. I haven't checked them all today, but of course Meta did have a fantastic post-earnings rally. They what investors wanted to hear was that Zuckerberg wasn't going to be spending every last cent on his vision of metaverse. In fact, he talked about the importance of execution, and of course unveiled a huge $40 billion share buyback program. So investors really liked that. They liked the idea of costs getting under control and them executing and then returning some capital to shareholders. But again, of that 40 billion, I would kind of pose this for the Meta bulls: how much of that is actually going to yield a reduction in shares outstanding, and versus how much of it is simply an offset to share-based compensation, which has kind of been a long-standing story in tech. These outsized share-based comp numbers, those are real costs, and if shares outstanding aren't actually going down, then you can call it a buyback. It is a buyback, but it's really just offsetting SBC dilution in many cases, or to a partial extent, rather than representing a reduction in share count. So just some thoughts. Those are, I guess, the three big items that I was seeing throughout this week. Clearly, the Fed, Cohen's news yesterday after hours, and just to circle back to the Cohen before I kind of open it up for conversation, it's not just Ryan Cohen. Wall Street Journal earlier this week had a story out about how Disney, Salesforce, and some others are drawing activist swarms after their share declines, a swarm being when more than one activist gets involved. So there were 17 instances in which a U.S. company drew more than one activist in 2022, according to Lazard. That's up from 9 in 21 and 7 in 2020. So while that's lower than pre-COVID, it is clearly an uptick from those depressed levels of swarming activists of the COVID years. So expect that to continue, especially for equity prices if they go back down after this crazy January rally, right? But you'll likely see at underperforming companies more activists pouncing. There's a lot of dry powder out there from the private equity side. There's still a lot of cash on the sidelines. So certainly Cohen is not the only activist out there. We're seeing an uptick in activism, and sounds like can expect that to continue rising back toward pre-COVID levels. So Joe, I'll pause there. I know a few folks have requested to speak, and I'll add them up as speakers. Kevin, I think I saw you first, and then Roasted Toasted. You're welcome to go next. Kevin, hey there. Kevin, I can't hear you if you're speaking. I know you requested a few minutes ago. Okay. All right, Roasted Toasted, you can go ahead while we see if Kevin comes back to the mic. All right. Well, I removed him from speakers. Kevin, if you wanted to chime in. I see you keep muting and unmuting. I can't hear you. I don't know if anyone else can. Okay. Well, I'll again kind of say if anyone wants to come up and chime in, you're welcome to request to be a speaker. Joe, what else is going on in markets that we didn't touch on, or what else are you seeing and hearing?
Well, this is actually the first time we've sent out a retweet on the GMEDD account, so we're excited to have some of the GMEDD people over here. Hopefully, going to talk about the Cohen buy a little bit more, get some discussion going on that. Big tech earnings, you kind of already covered it all. But if anyone from the GMEDD followers wants to come chime in, tell us what you think about Ryan Cohen's purchase. I know there's a lot of people that don't believe that it's real, which Rod's already dived into. I mean, there's no way he's letting these fake stories go around about what he purchased, especially from the Wall Street Journal, which has always been where the people familiar with the matters speak to.
Yeah, and I'll interject there, Joe. I mean, as you were the one who interviewed him, you obviously worked closely with his public relations contacts, and you perhaps know better than most how that works. That this is a pretty tightly controlled process. For folks, they manage their public relations pretty tightly. There are people that are paid good money to manage these relationships. It's inconceivable to me that Cohen's PR team is would not be involved in the sharing of that information with Wall Street Journal. And recall that Wall Street Journal had the exclusive, if you will, interview with Cohen that came out the day before Joe's interview with Cohen was published. This stuff is managed. It's not ad hoc.
Yeah, the Wall Street Journal isn't publishing anything just blatantly false about Cohen, especially considering it clearly had contact with him. So I don't think anyone that worries about that should worry about that. But we've added up some new speakers here. Kevin, we'll give you one more chance. It looks like you're now showing up as a speaker on my end, so maybe there was just some Twitter difficulties, but you can go ahead.
Hey, sorry about that. Can you guys hear me now?
Yes.
Okay, perfect. You kind of already answered my question. My follow-up question was just in regards to the reporting around Ryan Cohen's buy. I just found it strange because it was just a few months ago where we got similar reporting that he purchased a stake in Netflix, and then a few weeks ago it was Alibaba, and now the reporting is Nordstrom. At least Nordstrom feels like it's in his MO, but the first two didn't. So yeah, my question was just surrounding sort of, is there any way besides the 13D filing to get any kind of confirmation?
Look, I mean, yeah, he's a private citizen. He can buy and sell and trade things wherever he wants. When I personally spoke with him, I brought up how before GameStop, he had very few known trades, and we all thought like he only owned Wells Fargo and Apple. And when I brought that up to him, he's like, "Well, yeah, those are the only ones that were publicly known." So it's clear that he's owned positions in many, many companies over the years, and just chooses to disclose only some of them for whatever reason. Obviously we just have to be speculating, but yeah, so I don't doubt the validity of any of the stuff the Wall Street Journal puts out. And he's also
I would note that Alibaba is not outside of. I mean, Alibaba is think like Amazon-esque of China, and while Chewy, of course, was a more specialty online retailer, it doesn't strike me as outside of his wheelhouse at all. He's clearly had an admiration for Chinese work ethic for some time, and I think that the purpose of that public relations with Baba, for one, he clearly had an opinion that it would be accretive for them to accelerate buybacks, at least if we take the reporting to be true, and that he, as a very small owner, right, was able to effectuate that on the Chinese, company. So it's not common for an American to step into a Chinese company and recommend activist action and then respond going along with it. That's what the reporting implies. Whether that's 100% true or if that's nuggets of truth amid some trying to shape the narrative, right? We don't know. But that's my perception, is that he again, he clearly enjoys the role of an activist. He's now done it presumably 4 times, and I expect he will continue. There's no reason why one should expect that he won't. So that's just my thoughts on it, Kevin. But Cardi, Loop Ring, please go ahead, and then Chris.
Yeah, I just want to kind of chime in with this because it was really interesting when the Alibaba article dropped. Loopring is
Your signal's kind of choppy, coming in and out.
sorry, one sec. Is it better now?
It's
Can you
better
hear me?
now.
All right, my bad.
Yep.
So,
It's better now.
Alibaba is the largest patent holder for blockchain, and Loopring and Alibaba actually have a patent that's currently pending right now. The last status date is 2021. I'm going to try to find a link for it right now, but I just wanted to add that as well, that kind of piqued my interest because I do remember Loopring and Alibaba working on stuff, so it's just really coincidental given that from the past, basically. All I wanted to add right now.
Oh, interesting. Good. Thanks for sharing that nugget, Cardi. I was just going to share another nugget that I picked up in the Wall Street Journal reporting. It notes the people who I know the name of Cohen's PR guy. I'm not going to share that publicly, but the people familiar with the matter, aka Cohen's PR team, noted that he'd previously traveled to Seattle. This is on the Nordstrom side, not on the Baba side, to meet with the family and learn more about the business. When I read this, it seems like it's, there might be something personal clearly with the Mark Triton. It looks like he just really wants to get rid of him, and he doesn't like the guy. But he notes, and the reporting notes, that he has a lot of respect for the family that runs Nordstrom, and he's clearly gone and met them in person again, per the reporting. So it doesn't sound like, yeah, it's new, of course, to the market participants, and clearly the market participants felt that it was worth rewarding the company with a somewhat of a re-rating on its multiple today of that 25% jump. But it's not like he, none of us know what's in the guy's head, but it doesn't seem like it's a completely out of the blue thing. Any of these campaigns, to me, they're all kind of retail oriented businesses. He noted he's a fan of the customer service and the customer experience focus of Nordstrom, which for Chewy, of course, that's been the thing that's enabled them to have such great customer retention, is that obsession with service and that willingness to sacrifice, maybe margins in the short term to ensure you keep a lifetime customer. So again, I understand why some people have skepticism, but to me, it doesn't read out of line with what he's done to date and what he'll likely continue to do going forward. And that was partially a response to Nico had replied. So again, if you reply below the tweet, I'll try to note it. If you don't want to come up and speak, we'll try to address any questions there too. But Chris R, Bed Bath, how's things going, buddy?
Yeah, not much has really changed. Actually, yeah. I mean, there was the coupon payment on February 1st, and there was a lot of confusion because some people were getting a coupon, some people weren't. I currently have bonds in 2 different brokerages. I have some in E-Trade and some in Interactive Brokers. And my E-Trade account posted an interest payment, and I got the cash in my account on the 2nd of February. And then my Interactive Brokers account never got the coupon payments. So I don't know if it was a mistake or they're going to pay it or they won't pay it. There's a lot of confusion going on right now. There was a screenshot posted on Reddit from some guy with a Morgan Stanley account who initially received the interest payment, and then it looked like it got clawed back. They reversed it. So I don't know if it was a situation where they there was an issue with the transfer, or they thought they had paid it but they didn't, or they caught it back somehow. I don't even know how that would work, but there's still a lot of confusion about it. Of course, you have people on both sides of the situation. You have people who are bullish and think there's going to be a merger, saying they did pay it, and then you have people who are like short sellers, right? Or they don't like the company, they wanted to go bankrupt, or saying that it wasn't paid, and it's just very confusing.
Yeah, for sure. I saw that. I saw there were people sharing screenshots of the reversal, like you noted. Clearly the payment was due. It's a very strange situation, and we've talked about it a few times in the past few weeks. And for anyone not familiar with the matter, Bed Bath & Beyond has, they're in default. JP Morgan, the secured lenders, basically there was a breach and they're in default. If they don't make the payment on the bonds, there's a 30-day grace period in which they could make that payment to get back on track. But either way, the deteriorating financials of the company, barring a white knight appearing, and I know that the reporting from a couple of different media outlets was that there was not a buyer waiting in the wings. At least most recently, I haven't seen any different reporting, and correct me if I'm wrong, but that the company's more likely to, I think that the base case has to be an assumption there would be a Chapter 11 restructuring. There could be a Chapter 7 liquidation. There could be a buyer, but I'm leaning toward the Chapter 11, and there could be a sale, of that baby business in bankruptcy. It's messier than if they were to sell it before, but the fact that they're in default, that there's all this uncertainty and seemingly not payment made on the bonds, I'm inclined to believe that a Chapter 11 restructuring is in bankruptcy.
I don't think there's going to be a sale beforehand, and the reason why is because of those NOLs. If you have a change of control of a company, you're going to have trouble carrying over those NOLs from the previous company to the new company.
And Chris, what's an NOL for folks who might not know the acronym?
Net operating losses. So it's basically tax deductions you can get from losses that Bed Bath & Beyond made. So
which have real value, right? Those can offset taxable gains, right?
Yeah, and in Chapter 11, this is a very good feature of Chapter 11. You can, if you play it right, you can carry those forward into the restructured business, and you can avoid paying taxes for a few years because of those losses that the company actually incurred.
Yep, good insight. Thank you for sharing that with everyone.
Yeah, it's interesting, and Chapter 11, maybe even 7, aren't off the table, but in my eyes, something that not a lot of people still want to try to talk about, that debt can be bought, for like pennies on the dollar. It's very likely that somebody could be and could have been continuing to buy up a lot of the debt and converting it and being able to get rid of a lot of the debt and buy out the company, i.e. someone like Icon, who owns West Point Homes, which already does lots of business at Bed Bath & Beyond. So, and then selling an asset like Baby, it would be much easier for the sale to happen without bankruptcy. My opinions for that, honestly, let's see. I mean, assets and liabilities of the target company will become clearer and easier to assess if there's no bankruptcy filing. Legal proceedings related to the bankruptcy can delay or even prevent the acquisition. Bankruptcy could result in a decline in the value of the target company, making the acquisition less attractive. The acquiring company could lose bargaining power in negotiation with creditors, suppliers, and customers of the target company. Reputation of the acquired company can be negatively affected if it's perceived as taking advantage of a distressed company. And it is very clear that they will not file Chapter 7 or 11 if all of those things are taken into account. But hey, there's still a non-zero chance, I'm saying. But it would be extremely foolish for someone that's trying to take over the company to not go through buying a lot of the bonds and converting it and getting rid of the debt that way, and then doing an offering on a short squeeze.
Well, there was the bond exchange that they pulled, Chris, right? No?
Yeah, there was a tender offer but that didn't involve equity. It involved convertible bonds. that were being offered at much lower par than the old bonds. But I think the issue there is if you're going to try to acquire a company through debt acquisition, right, buying the bonds, if you acquire over 50% of the company, and then there's a bunch of rules about it, but like if you try to do that, you won't be able to. It'll count as a change of control, and you won't be able to carry forward the NOLs, right, which is like hundreds of millions of dollars worth of deductions. So I think it's probably better to wait for a Chapter 11 if I'm an acquirer. And I mean, there are provisions in Chapter 11 about fair market value, right? If you're going to liquidate, right, you can't just, strong arm a company into selling stuff below fair market value. There's a lot of legal issues, right? But yeah, it is possible, right? I mean, anything can happen, right? If somebody wants to pay, but it's just not likely.
I'm seeing this is from, what is today? It's today the 3rd. This was from yesterday night. It was Bloomberg reporting that Bed Bath & Beyond ex-employees reporting delays in their severance pay. So, quote, some former employees received an email from the Human Resources Department that read, we're reaching out to inform you there's been a delay with your payment. We are working to provide you with an update, and we are aiming to be back in touch by Wednesday, February 8th. So the email didn't explain the significance of that date. So again, whatever is going to happen, given the missed-ish payment, is going to happen sooner rather than later. It's going to happen within the next few weeks. It could happen at any point in time, right? There's I understand the perspective of some that there may be an entity that's interested in acquiring the assets, and I think that's where, as Chris was noting, there's a lot of puts and takes about would it be better for you to get it now, or would it be better for you to just wait and do it? And as you noted, Cardi, there's obviously challenges with doing it in the bankruptcy process, but there's also the change in control that Chris noted. So it's definitely complicated. And the one thing that's certain is that the specialists that Bed Bath's been churning through over the last few months are getting paid, baby. They have hired several restructuring entities. They've added a restructuring specialist to the board, right? That they're paying, I think, what is it, $30,000 a month. So clearly they're investing a lot of time and resources in trying to figure out what the right step is, but it's all speculative. And I'll reiterate my view that the equity is likely to end up being worthless, given you have the secured creditors and the unsecured creditors to get through before equity were to see anything. And it's just highly speculative, no matter how you slice it. But we'll see what happens. I'm just again trying to look through if there's any comments in Twitter notifications, but I'm not seeing any new ones. If anyone wants to come up as a speaker, Great Game is up. Please go ahead.
Yeah, so I kind of have two questions. First is, I guess since you kind of know and have talked to Ryan Cohen in the past, was curious if he's the type of person that would write an activist letter to the board and then buy a position and then sell it and then not think about potentially buying back in. And then the second question that I just wanted to kind of maybe just ask you about, like, kind of your thoughts on it, was more about it's kind of hard to ignore the large short interest position in Bed Bath, and it's been on the Reg Show threshold security list since January 10th, and I'm not sure what your thoughts are on if that plays a role in one way or another in the coming weeks.
So on the short interest side, I would step back and think, why is that short interest elevated? There's a meaningful contingent. Let me just check short site, at least S3 Partners. Short interest in terms of nominal shares over the last 90 days have risen from, per their estimate, 32 million to just about 60 million shares short, which during that period of time, though, the stock has gone from $4 down to $1.30 and change, spiked back up, and now it's kind of doing its own thing again. It's a little lower than it was 90 days ago with twice the short interest, but you need to recognize that the folks that are making that short bet have likely analyzed the situation and come to their view that equity is likely to be worth less going forward than it is presently, even after you net out the expensive cost to borrow for them. So while wild price movements could continue to happen as they have, I wouldn't interpret that as meaning that the company is going to survive without a Chapter 11 or Chapter 7 or some restructuring event. It's just a very volatile security. It's got a lot of, I think, traders on the retail side playing it. There's just in the GMEDD Discord, there's a lot of folks who've been in it for over, we're coming up on a year now, as they got interested in it when Cohen initially got involved. And as you noted, he did sell. He did reach a standstill agreement in March of last year with the company, which is when he seated the 3 directors to the board. And as I have the standstill agreement in front of me. I haven't reread it recently. My understanding is that just because he sold, right, he's still bound to the standstill agreement, and I don't recall when it expires precisely. If somebody does know offhand, please chime in. But he can't just swoop in and do something if he's still bound by the standstill.
The standstill expired on January 2nd.
Okay.
I mean, so like with him selling his position, taking him away from any possible market manipulation / insider trading on an M&A to, kind of like seal his, to protect his legal side of things. I mean, it still seems more likely that there's not a BK, even though it's still possible. I would give it at this point a 20% chance, given all the extra weirdness going around everywhere else. And this is Cohen and possibly Carl Icahn. I say possibly. It's not definitive at all, but I really think that with everything that's happening, it's so many weird things going on. I just don't see a Chapter 11 or 7 happening when there's a way out of this, clearly, without doing something. These guys
I agree
really
with you.
smart.
I agree with you. I just don't see how someone could, write a letter like he did, that activist letter. And then, especially like the bottom paragraphs talking about, maybe taking Bed Bath private and then maybe a spin off of Baby. There's too many, like, why would he write all that, and then
but bear in mind, he wrote that letter in the first quarter of 2022.
Yeah, but then
where Fed funds rate was near zero. And things have meaningfully changed in the real economy in the period of time in which that letter was written. The business has deteriorated meaningfully in the period of time since that letter was written. So while that may have been his view at that point in time, I think it would be misguided to believe that things haven't changed in his thinking pertaining to BBBY in the ensuing time since then. So I would just caution reading too hard into the letter, from that point in time, knowing just like a month after that, right? Elon Musk obviously moved forward with his Twitter M&A, which he clearly came to regret the price he opted to pay, and the economy deteriorated. Valuations for communication services companies deteriorated. So just like valuations for retail businesses deteriorated broadly, and Bed Bath, as a home goods seller, saw meaningful headwinds in its operating business. So I would just caution reading too hard into that letter.
He's pretty, I guess, up in, from the time he purchased and sold. So I don't know if he would think about potentially buying back in now that his, he could significantly get more of the company than he had previously at these prices. I'm just, asking the question. I'm just curious. Since you've known him,
he wants Baby. Teddy was formed in early 2021, and then we had the 2 Ted tweets subsequent to one picture of his dad, Ted. I mean, it's just like he's going after Baby, and has been from the beginning. But it's just he's cryptic for a reason, and people can try to say, people look at his tweets with schizo tendencies.
I mean, he explicitly said otherwise. Just to kind of push back on that, he explicitly noted there's no cryptic meaning to his tweets when Joe asked him. Joe, I don't know if you would add anything to that.
Yeah, that's what he said. And people have continued to state he's just speaking on the record. I do think he has a lot of fun
That's
with
what
his
he
Twitter
said.
account. And I do think there's a lot of comments he'll make that he knows people are going to run with. And I think he has fun, but I don't think it's worth like digging into them personally, at least not anymore. Like even with GMEDD, when we used to like retweet everything he said and add a little commentary, we're largely just like having fun, and I would never base any financial decisions on things that he tweets.
Yeah, what changed from that point until now? Like what made you kind of stop speculating on his tweets? Because
Well, when we had
that's
the
it's still
interview,
what I'm doing,
when I
having fun.
conducted
Nothing changed
his
there.
first video interview like that, it was just a point where I knew we couldn't do any better than that. I mean, we talked to the man himself, which is what we'd been speculating over, like his actions for over a year, much more than a year, and like there's no way to continue investigating what he does, given that I can now just kind of ask him. you know it's like, am I going to look at these breadcrumbs and try and pick up these pieces of some big puzzle when I could just reach out to the man himself and ask him the question if I was so curious? And to be honest, I'm not. I think we're in a totally different market. Interest rates are no longer 0%. The company, GameStop, is likely focused on cost cutting and optimizing the balance sheet, so there's going to be less and less really cool stuff to figure out. And besides, like, there's going to be layoffs, there's going to be restructuring, and that's not something I want to investigate. That's not something that's worth putting out pieces for, at least for me personally. So if obviously there are people that still look into the company every day, and that's great, but it's just not for me.
Yeah, nothing wrong with that at all. I still think it's interesting. Teddy, he has a plan with Teddy, so we're just yet to see what he's going to do with that. It's a holding company, the entity types bank. Um, so yeah, we'll have to see. It's interesting. I have to go. I have to get to the gym, but thanks for this. This was fun, and I hope you guys have a blessed, good rest of your day.
Thanks, man. Have a good workout. Again, it's about 5 to the top of the hour. I had noted that we'll probably run this a little bit shorter than usual, given the circumstances. So I'll probably run it at least another 20 minutes or so, if we can have some good conversation. If anyone wants to add to any of the discussion, whether it's on Cohen and his ongoing activism, whether it's the Fed, their phrasing, their correct or incorrect interpretation by the markets, and whether it's big tech, and whether their growth, their gaudy growth of the COVID era is behind them, and whether they'll ever get back to that growth rate again. I certainly welcome any input on any of those. I'm trying, but my internet is not working for me. I was going to note what the decline in sales, though, for Bed Bath was, because again, I think it's just really important to kind of step back and recognize that the business. I had stopped looking at the foot traffic data, but I was looking at it from Placer.ai data several months back, and out of the entire retail universe, it was the worst performer. We were talking about 30 to 40% declines in foot traffic year over year. The sales results are kind of in line with that. The business is challenged, and if I were a multi-billionaire that were interested in the business, I'd rather transact in bankruptcy at this point in time with how things sit. That's me personally. We'll see, right? There certainly anything can happen.
Yeah, their market share, I think, showed a decline last quarter. The earnings were really bad. They were like minus 390 after that 10Q came out, the late filing, 390 million. So that's a big loss to post. And their ABL is very likely maxed out, right? There's the 1.1 billion on the ABL, and then the FILO is 375 million. So it's about 1.4 billion in debt that they've maxed out, very likely, and they have to pay interest on that too. So we'll have.
I got my internet to work. So to add to that, a couple of things. So I'm looking at analyst estimates. At the analyst estimates, the consensus from the sell side analysts in the first quarter of 2022 were that over the next 12 months, Bed Bath would be realizing sales a bit shy of 8 billion. The current estimate is closer to 5 billion. So again, we're talking about a 40-ish% deterioration in the top line sales. And when you think about retailers like Bed Bath, that the impact of that on their bottom line is devastating. I mean, their EBITDA figure a year ago was estimated to be positive. It was over the next 12 months. It was estimated to be $370-ish million. Whereas if we come to today with that 3 billion delta in sales, the delta on the EBITDA line is about $800 million. So they went from plus 370 next 12-month estimate to negative 530. So pretty devastating swings. The business, again, it deteriorated. They went through this attempted transformation that, with Mark Triton's leadership, clearly didn't work well. There was the COVID challenges that didn't make it any easier for them. They lost foot traffic. Think about them being closed during COVID when people could instead go into Walmart and Target and perhaps became comfortable shopping for home-related furnishings at Target. I mean, they've ceded market share, and to get that share back will require marketing investments, right? And they don't have the money to do these things presently. It's just not a good situation, unfortunately, if you look at the financials. And while I understand why people are kind of holding out hope that there will be a white knight that buys the business, the math just doesn't seem there for me. But I get it. So
there was a hope for some time that they could take advantage of the high implied volatility and carry out a tender offer, or issue some sort of exchange for their debt to capitalize on the very large retail interest in their options and stock. But it seems like there was not much interest in the tender offer. I mean, it was only 15% subscribed, so they had to cancel it, I guess, or they chose to cancel it.
Hey,
and as Carter noted earlier, the bonds, they're still trading at deeply distressed levels. It's still trading for 5 or 6 cents on the dollar, the unsecured debt, which the implication there being that unsecured creditors will not see a recovery, and therefore if they are not seeing a recovery, equity comes after them in line. So that's why I keep noting that $300+ million market cap comes after the Chris, better than me the exact amount of unsecured debt that's still outstanding.
About $1 billion.
There's
1 billion
about
plus
$1 billion that's got to get paid.
$760 million in accounts payable, I think, or $700 million in accounts payable.
Yeah.
So it was about 1.7 million. Plus, there's some other unsecured liabilities. I don't remember exactly what they were, but just shy of 2 billion, I guess.
Hey, just a quick comment on what you said, Rob, about marketing. Rod, sorry about that. Didn't mean to call you Rob. But yeah, I saw.
It's all good. It's happened before. It'll happen again.
Yeah, sorry about that. Yeah, I don't watch every day, but I was watching CNBC, like Squawk Box in the morning, and I saw a Bye Bye Baby commercial. So you want to talk about marketing? I mean, sounds like there could still be spend there. I don't know. Just wanted to comment that. Doesn't seem like they're doing nothing.
Okay. Got it. Thanks for that. Makes sense. Broadly, one other kind of comment I'll make on the retailer space is that, obviously we're talking about Bed Bath, but if you kind of step back and look at the retail space more broadly, retail over-earned like crazy and has been over-earning like crazy in COVID era, right? The gross margins were able to get bumped up nicely by retailers, and much of that margin flowed through to some pretty impressive earnings results. So like a lot of these retailers have been crazily over-earning with all of the fiscal stimulus that came through, with the goods-based spending that came through in late 2021 through to like earlier in 22. But as that mix shift back to services has continued, and as retail normalizes, I think you have to assume that if a company's earned a gross margin around, let's call it, I'll just say 30% for a decade preceding COVID, and then it went to 40%, my intuition would be a return to the mean is going to happen. You'll get gross margins back to where they used to be, and that means that those outsized earnings of COVID era will go away. So that's not a comment on any particular company. It's more about the retail space broadly. But I don't know that there are any folks out there calling for retail to continue its outsized performance. And if there are, I'd love to know what their logic is, and what they're seeing, and maybe they're seeing something I'm not. But retail as a sector has over-earned meaningfully, and it's kind of in that return to normal part that's going to play out over the next year or two. All right. Any other comments, thoughts? If anyone wants to come up and share what they're thinking. Otherwise, I'll wrap this. We'll get this wrapped up shortly. Let's see.
I will add, so earlier we talked about the conclusion of GME-DD, and I just want to, make sure everyone is well aware. All of us still, have so much respect for Ryan Cohen. Everything he accomplished with GameStop is really why we are here together. Like, I'm sitting next to Rod right now. We only ever met because we had the shared fascination for Cohen's activist campaign. And it really did change so many ordinary people's lives. So still just want to make sure everyone is aware, like, although, GME-DD, we're not continuing to investigate what's going on with GameStop, we are still fascinated with the company, fascinated with the chairman, and hope that people don't think we have any hard feelings.
Hey, since y'all are in Vegas, are y'all going to meet up with Sir Jack while exploring the Strip?
Well, a couple members of the team came in and decided to drop a couple stacks on the table that apparently they accumulated during their evening last night after they landed. So I'm kind of jealous of their fortune on the Strip to date. Haven't seen Sir Jack yet, but if he's around, I'd love to catch up with him and see him in person. Hopefully he'll take his helmet off for us. So somebody just commented about a potential Hertz situation. So I think this is something that is still fresh in a lot of retail investors' minds, right? Hertz went into bankruptcy, and the media reported, it's bankrupt. It's going to go to zero. Clearly, what happened with Hertz, though, with them being the owners of these assets, used vehicles that rapidly appreciated in value in a way that the pandemic effects, you couldn't have seen that coming. I guess most people, right, didn't see that coming. Clearly, the folks who maybe understood that those assets would appreciate made a lot of money on Hertz. But I think that what I see is a lot of people thinking that bankruptcy, it's normal for something like Hertz to happen. It's quite the opposite. That you would have a company like Hertz emerge from bankruptcy, in a strengthened position. Bed Bath doesn't have assets like Hertz does, right? The homewares sitting in a Bed Bath Beyond shelves, the baby related merchandise in a Bye Bye Baby, like those are not just going to become meaningfully more valuable. The inventory sitting on their books isn't the same as an automobile that that could be sold at auction in a COVID impacted environment. So I still keep seeing people getting very hyped about either bankrupt or imminently bankrupt retailers and assorted companies like that. And I still think that's leaving a bad short-term memory on people that what happened with Hertz is not typical. It's very much the opposite of it. And while that's not to say a Hertz-like situation can't happen in the future, you should expect the normal to be whether it's a Revlon or a Party City or now respectively Bed Bath, when a company pursues a bankruptcy restructuring, don't expect equity to be rewarded. Equity is often wiped out. So, okay. I'm not seeing anyone else put a hand up to speak. As I mentioned, I'm going to cut it a little bit short today. Greatly appreciate everyone for tuning in and being part of the conversation. Just as a reminder, Wook Capital Management's thesis, as Joe was getting at, is really a direct byproduct of what we experienced putting together our research that we shared, our crowdsourced research that we shared and participated in, and the Roaring Kitty chats, and that culminated in the GMEDD report that we put out in January of 2021. We are all about sharing information, learning, and growing together. We welcome folks to become Wookiees, join our network, wook.gg. We'll bring you to our Discord if you want to join and share your thoughts and kind of read what people are sharing there. We have an ongoing monthly book club. We're going to actually, as a team, I think, work on getting the schedule for the book club for the balance of the year out by next week. But we did review Margin of Safety by Seth Klarman earlier this week on Tuesday night. That's on our Wook Capital YouTube if you'd like to check out the replay. I think it was a nice conversation, kind of value investor oriented conversation. So we'll continue to host these book clubs. We're going to continue to host our weekly Friday Wookin' reviews at the close. We have a Wednesday open mic that we might push to Tuesday this coming week, and we'll do that at I think 8 o'clock Eastern this coming Tuesday. If you'd like to join, that'll be on my personal handle at Rod Alsman. I'll host that. So definitely, you're welcome to come and listen in on the conversation. It's just an open mic, market-oriented conversation. We do those typically on Wednesday nights, but we're just pushing it to Tuesday for this coming week. So thanks again, everybody, for tuning in to our Wookin' review this week. We sincerely appreciate your interest, and we hope to talk to you again soon. So cheers, everyone. Have a great weekend.